Hi, this is Rob and Mike from the McClellan Financial Group, and this is Think Smart with TMFG. Today's subject is the transition to the global portfolios. And it's something we've been doing a lot of in our office lately. And you mentioned an article that you had read that talked about some of the changes in the car industry and how it related to what's going on in today's financial industry. Do you want to touch on that a bit?
Well, I was reading an article by a financial advisor named Dave Shalhoub. Very good article. His father was a mechanic, and he talked about his experience working on cars as a child and compared it to some experience in the financial industry. And he said, as a son of most mechanics, you start off by pumping gas, and then eventually you move to changing oil on cars, and then you start changing tires. Eventually you're working on carburetors, you're adjusting the points on a car, adjusting the timing. And he talked about all what he learned over that time. The interesting observation, he said, is nowadays when he drives a car, he buys a new car, and he can essentially drive a car for 200,000 kilometers with only changing the oil, never doing any adjustments, never doing any major maintenance like he used to. He loved the old cars, but he said every 10,000 kilometers you have to open the hood and do a ton of work and adjustments to it. So he's just saying how far the auto industry has advanced over the last 30 and 40 years. And, you know, when you take this and look at it from the financial industry point of view, we've had tremendous advancements over the last 30 to 40 years, too. Something that you can think of.
Well, I started in the industry in 1991, and I started with a small firm called Brightside Financial and worked with a gentleman by the name of Rand Musselman. And he was considered sort of a financial advisor guru. He had been in the industry for a long time, and he played a major role in getting mutual funds started in Canada. And he basically taught me, how to go about picking mutual funds according to him. And so when I started building portfolios for clients, I would use Rand's method of picking mutual funds.
At that time, it was a much better system than the old stock system, wasn't it?
Well, it was, because you no longer had to buy, individual stocks. You now had the ability to get U.S. stocks, international stocks, even emerging market stocks that didn't exist before. You couldn't buy them on different exchanges. You could only buy probably Canadian and U.S.
It's a huge advancement.
It was. The only issue is after a few years of doing this, I sort of came to the conclusion that it really wasn't working for my clients. And the biggest problem was that I would pick these funds. They all had great track records coming in, and the minute I put them on my team, they were no longer that good. And so we would go out and look for some better funds, and we'd bring them on board. And it wasn't working for me. It wasn't working for my clients, and we needed a new solution. So we were, I would call, an early adopter in some of the wrap programs that started to be made available in Canada. Do you remember what those were?
Remember the first one was the McKinsey STAR program, and there were a lot of followers after that. CI had one, Fidelity had one, and of course we were using Optimum Strategy at that time, which was by Asante, which was probably one of the better programs at the time.
It certainly was. It had all the bells and whistles that you needed. It had rebalancing. It had all the different asset classes. It had managers from many different companies. It had the tax allocation, and it had great client reporting. But there were some issues. What were the issues?
Issues were generally fees. I mean, to be honest, other than the fees, it was a very, very good program. We weren't crazy as these programs began to... sometimes the managers they picked were suspect. I'll put it that way. The companies started to use their own managers to save money on the products. And when they started to pull all their own managers into the products, you realize it was no longer a non-biased opinion as to who was running the money.
Yeah, definitely. It was no longer non-biased. I think the other issue, the fees were high. They were in the 3 to 4% range. And, with interest rates starting to come down, you could no longer justify that expense to manage a client's investment portfolio. What ended up happening is their financial plans weren't working. And that was probably the biggest thing for me to bring about a change.
Well, when we first started to use them, it was in the mid-90s. But our average client annual return, I think at one point in the 90s, was something ridiculous, like 18% a year. So no one was too worried about paying a 3% fee. But obviously times have changed quite a bit.
They have. I remember, I think it was 2003, you and I decided we needed to make a change. And we went out and looked, what was available, what were all the solutions, who were the best fund pickers, what should we do, should we use stocks and bonds? And we were introduced to what was called factor investing, and we were introduced to, dimensional fund advisors. And so that was a big change for us. We were able to reduce clients' fees by about a full percentage point. We were able to start building these portfolios, but it was early days. There were some issues. By lowering the client's fees, we had to, give up a few things. What were some of the things we gave up that was tough to explain to clients?
Biggest thing was the automatic rebalancing. I mean, we had to take on a manual rebalancing system, which was we had to start a whole new department in our company to take care of the rebalancing work, which used to be done at the fund level. So that was a big change.
I also think reporting got far worse. Before, we had these beautiful consolidated reports with rate of return. The portfolios were what were called tax effective. It was ideal, but the cost was too high, and suddenly we had to move to this cheaper solution that still had great performance, had lower fees, but didn't have the reporting and the rebalancing.
We had a dream at that time if we could rebuild the system we had at a low cost without having to use their managers, we would have the dream system. But it wasn't instant. It took a while to get to that point.
So we kept working at that. And then, I think it was about 2011 when Dimensional launched what were called the first global portfolios. And what they would do is they would put the funds together for you, similar to what the WRAP programs did, except the fees were, half of what they used to be. And suddenly the rebalancing happened automatically. And that was a big transition. It was actually one of the gentlemen in my study group who was the one who was making a big push to have this done. He said to Dimensional, why don't you guys put the portfolios together and make life a lot simpler? So we started using them, but you and I didn't fully buy in. We did for small accounts, things like TFSAs, RESPs, small in trust accounts, but that was about it.
Big issue we were running into was tax allocation. What we considered a big advantage for running the portfolios how we have in the past was we could allocate the interest income to the registered accounts. And that's a big deal on a Canadian portfolio. And when we ran that in our financial plans, we found when we ran a portfolio that way, we'd have a much higher success rate on their financial plans.
So jump forward to the middle of 2018, and we finally get Dimensional to agree to create a global bond fund. And what does that allow us to do?
What it allows us to have a balanced portfolio that can have consistent rebalancing on the equity side and on the bond side, and still allow us to allocate the taxes to the proper accounts. Best of both worlds at a low cost.
So if you look back, we've essentially cut our fees in half, which means clients' portfolios are getting the returns they need to make the plan work. We've solved the rebalancing problem. We've solved the reporting problem. And we've solved the tax problem.
It's just much more efficient. When we go back to the car analogy, I remember you always told me your dad drove a 65 Mustang. And a beautiful car, one of my favorite cars. But how would you feel driving that today?
Well, the last time I took it into the mechanic to get it fixed, he told me I needed to sell the car. And he said the reason you need to sell it is because this thing's starting to rust out and it's about to fold in half. So I wouldn't feel too safe driving that car today, to say the least. You know, it's interesting you go back to the car industry and what car companies have been able to do today is really focus on all the other things, such as safety standards in their cars. And now you've got all these bells and whistles and lights that go off when you approach things. And, you know, in the future, maybe you don't even need to drive the car will drive itself.
Yep. Tremendous amounts of advancements. And again, we've seen a very similar thing in the financial field. So we're very thankful for it.
So I think it begs the question, you know, where does that leave us? We've made the portfolio easier to manage. What does that free up our time to do?
Well, big thing is financial planning, estate planning, tax planning, risk management have all become more important than they were in the past. Taxes have went up. If you don't look at how to structure your portfolio in the right way, you're going to be killed on taxes. You're going to give away a lot of your money to the government for no reason. So if we can work on structuring the portfolios to limit the amount of tax and to make sure that your portfolio is passed on to your family as you want it to be, is going to be of great value to everyone.
So all this change in technology is helping. At the end of the day, clients have better financial plans. What more could we ask?
Well, that's it.
And a higher chance of those plans working out for them. So this is Rob and Mike with Think Smart at TMFG.
You have been listening to the McClellan Financial Group of Asante Capital Management Limited. Asante Capital Management Limited is a member of the Canadian Investor Protection Fund, an investment industry regulatory organization of Canada. Insurance products and services are provided through Asante Estate and Insurance Services Incorporated. This material is provided for general information and is subject to change without notice. Every effort has been made to compile this material from reliable sources, however, no warranty can be made as to its accuracy or completeness. Before acting on any of the above, please make sure to see a professional advisor for individual financial advice based on your personal circumstances.